Largely lower, and that is the kind of moves that we've been seeing in those markets yesterday as well.
We're not entirely sure what's going on, but we can see some trends in other markets.
The year-on-year number looks much higher because remember the comparable quarter, the base quarter of last year was impacted due to COVID.
The index itself is up marginally, not too much, about 20 points higher.
We've got big Indian companies like TCS, like HDFC Bank, reporting sparkling results. Your FII flows coming in.
Pullback basically means that it's only making the structure more robust.
An 865 crore IPO, not done really well in the opening tick.
India's first flagship Apple retail store open to the public, and there's no other than SimSource welcoming all of them into the Apple ecosystem.
Credit card spends grew by 28.2% YOY and about 15.7% on a month-on-month basis to more than 1,35,000 crore.
I think what's happened in the first quarter of this calendar year is something that was really expected. The sentiment across the globe has been very tepid.
Thousands of people queuing up, some as early as last evening, who camped all night.
Nifty continues to see some pressure, 38 points down, and that is something that the SGX Nifty was indicating as well.
How was the day so far? Hello and welcome to Closing Bell. I'm Reema Tendulkar, with me Surabhi Upadhyay and Nigel D'Souza, and we're coming to you live from the CNBC-TV18 Motilal Oswal studio. Well, the day so far, it started off strong in the green, and then there was a sudden slump in the market about 1:30 p.m., 2 o'clock, and now things are trying to stabilize. Since about 2 p.m., markets are trying to recover. That trend is more apparent in the banking space. The Nifty banking index was holding up with a gain of about 200 points. At 1:30 p.m., we had a sharp fall. The Nifty bank went down to a cut of minus 100 points, and now it's completely flattened out. Today, remember, is the financial Nifty expiry, so we will be tracking that very closely, and it tends to move stocks like HDFC Bank, ICICI Bank, and Kotak Mahindra Bank. Mid-cap outperformance is quite stark today. So the mid-cap index is up close to about 0.6%. And in the last 2 days, we're just on Tuesday, but the mid-cap outperformance is to the tune of 2%. So week to date, mid-cap index is up 1%, while the Nifty is down close to about 1%. What's the problem on the front line? Well, it's Reliance Industries. So Reliance Industries is down 1.5%. So yesterday, the problem at the benchmark level was Infosys, HDFC Bank, and a couple of the other IT names along with Infosys. But today, those segments have stabilized. Infosys, the last time I checked, actually had a bit of a green tick. So they've not rebounded, but at least they have stabilized. Even HDFC Bank, the last time I checked, was just a flat. Given the sell-off that we had in the last 30 minutes, the HDFC Bank stock has dipped into the red. But again, things are on the stable side when it comes to these two names, Infosys and HDFC Bank, the culprits in yesterday's trade. Today, the problem is Reliance Industries. With its 10% weightage, it's taking down the Nifty to some extent. Hi, Subhi. Hi, Nigel. What are you all tracking?
Hi, Reema. Hi, Nigel. Two things. One, I was looking at the decline on the bank index, and I think that's been an interesting story today because at least in the first half, the bulls were hoping that banks are going to keep, the things steady. That picture's turned around. And the second is pharma. I was just speaking with Gurmeet Chadha on our digital show, Who Moved the Market Right Now. And I think this is a narrative that's really been building up. Ekta and I were discussing it. We'll talk about this on the show as well. A lot of money moving to pharma on the anticipation that the US market pricing pressure is coming off. In general, some hope that earnings will start getting a little better. And the sector hasn't participated. The only problem is that pharma, in terms of weightage, doesn't really move the needle too much for the Nifty. But for what it's worth, I think Devi, Cipla, Dr. Reddy's, the kind of buying that we've started seeing here, this is interesting. I guess sector rotation is still the theme. Money moving a little away from IT and trying to find new pockets. Nigel, what's your read-through of the day?
Well, the buyer dips is intact till that 17,500, 17,550 odd level holds out. And I say that because the 50 and the 200 EMA, both of them are in that vicinity. And yesterday's low is at around 17,570. So that's the reason why I'm holding on to that level. Now, the sectorial rotation continues. And as Surabhi, you mentioned, that the pharma sector is coming in focus. One school of thought is that in terms of defensives, you can't go to IT because still things are a little bit skittish. So the one that's underperformed for the last many years and maybe valuation-wise as well, reasonable with what we have seen in the past. So maybe there is some part of the defensive money that's moving to pharma. The mid-cap index, their outperformance out there, for me, that's the biggest positive. If we pull up the Nifty and you pull up the mid-cap index, month to date, or in the last 1 month or so, you'll see the mid-cap index that was actually getting clobbered, mid and small caps, they have bounced back in style, particularly in this month itself. And, April as a month has always been good for the broader markets in comparison with the Nifty. Maybe we could get a 1 month chart of the small cap, the mid cap, as well as the Nifty up. We'll do that in just a bit. The options data, 17,750 and 17,700 call. Both of them are very, very active in today's trading session. And there's a fair bit of writing that we've seen out there. After many, many days, call writing has coming back in. Now, that's telling you that the level, that 17,850, which is closer to around that 100 EMA, and it's closer to the recent high as well. So the bears are going to come in and fight the 17,850. But positioning as we speak, it appears that we'll require a bigger trigger to get past that 17,850 to around 17,900 odd mark. So broad range, 17,550 on the downside, 17,850 on the upside. So 300-point range. Let's see which way it's going to break.
Okay, that's the 300-point range that we need to track. By the way, banks are putting in a fight right now on the way up. Pull up a Bank of Baroda, up 1.25%. Pull up a Canara Bank, that's up 0.6%. Bank of India, big spike seen in the last 10 minutes. That intraday will come up. There you have Bank of Baroda, Bank of India and Canara Bank. These three stocks will tell you the picture of what's taking place in the mid-cap space. Let's tell our viewers then what we've lined up on the show today. Just Style surges in trade on the back of a good set of Q4 earnings. Key excerpts from our chat with the management coming up.
BEML trades in the green after shares of BEML land assets are all set to be listed in the market tomorrow. We'll get you an analysis on how the valuations are.
Nifty Pharma Index up 6% in the last 1 month. Brokerage firms, JP Morgan, Citi are positive on a host of pharma stocks. Details coming up.
We'll speak with Jay Bala of cashthechaos.com, talk about market technicals. Jay, of course, has been maintaining a bearish stance on the market. On the fundamentals, we're talking to Aman Chauhan of Abacus Asset Management. We'll discuss their portfolio positioning in the market now.
Well, how do you position yourself in the last hour of trade? To help us out with that, Mitesh is back with us. Well, Mitesh, it appears that those dips are getting bought into, but we're not being able to break above the 17,700 odd mark. How do you trade the index as we speak? And also the Nifty Bank, from trading well in the green, well, that's come off a little bit. So any levels you're watching out there?
Good afternoon, Nigel. So the overall understanding is that the broader trend is on the upside. But on an immediate basis with the fall which happened with Infosys numbers yesterday, the short-term or the immediate intraday trend has kind of, the uptrend has kind of got violated and it's turned into a consolidation, which is broadly choppy. But I believe that it will be a range consolidation because the daily, the weekly and the other medium-term charts are still very positive. Having said that, therefore, I think, we can identify the counters of this range, which is 17,550, 570 broadly on the downside to about 17,820 on the upside. And therefore, you will see declines being bought into. I think the idea should be that we, as a trader, should be positioned to buy near support areas and then, take profits slightly on the quicker side purely because of the fact that this is not a market which will immediately make newer highs. Having said that, on the stock side, we're trading with long bias, and the Nifty Pharma Index, I think that's come on the radar again after a couple of days of break. And DVs is my first buy call. This was, a strong performer a few days back as well. Now it can be bought afresh. Keep a stop below 32.30 and a target of around 33.50 can be looked at. While I also like Glenmark, which I would recommend buying with the stop just below levels of 498 for targets of 520.
Divi's Laboratory, what a move on the stock. 3.5% gain today and 16% up move since the start of this month itself. Another one that we're tracking is BEML. The shares of BEML land assets will be listed tomorrow. Vivek is here with the details and what the valuation of the land business could look like. Vivek.
Well, absolutely right. So both BEML as well as, the entity that's going to be listed tomorrow are in focus. So first, let's understand what exactly does BEML Land Assets Limited actually own. As the name suggests, it has around 550 acres of land parcels, and this is spread across both Bangalore as well as Mysore. Remember, BEML shareholders had actually received shares in BEML Land Assets Limited in a 1:1 ratio as early as in October 2022. So the street has been waiting for quite some time for these shares to be listed. Now, going forward, why is BEML is focused? Number one, this actually clears the deck as far as the government's partial divestment in BEML is concerned. And in fact, the government is looking to sell close to 26% stake. And one of the conditions for the process to move forward was the listing of the Land Asset Bank. So now at the end of the December quarter, the government held 54% stake in BEML, Land Assets Value, as well as BEML. And the market cap, now this is where it gets interesting, the market cap of BEML is at currently just around 5,070 crore. But as per analysts who have actually gone ahead and done a real estate valuation for the land assets value business, they've estimated the value of the land bank at close to 8,400 crore, which works out to the value of the land assets at between 500 to 525 rupees a share, which is where analysts are expecting this particular company to list at tomorrow. So it'll be interesting to see how exactly the listing happens. And remember also that the stock would be listed in the T2T or the trade to trade segment. So for the next 10 days, it will remain in that segment.
Thanks a lot for that, Vivek. Dipan Mehta, Director at Elixir Equities, joins us on the show. Hi, Dipan. Good afternoon. Thanks so much for joining in. Any view on the current listed stock? That's BEML. The hope is that, obviously, the stock is higher. The hope is that the divestment goes ahead. And, already the land assets have been now separated. So if you could give us the view on the stock around 1,200 rupees and any value you're assigning to the company that will list tomorrow, which houses the land assets?
Yeah, Raja, thank you for having me on your show. Actually, BEML has just fallen through the cracks over years. The performance has been so mixed over the past several years or so, and it's not created any great value. Even when other PSU stocks were adding, this has been a bit of an underperformer compared to that. So not really tracking it, and I have no idea what the fair value of the land holding would be. But yes, I think if privatization does take place, then that would be really a big trigger for BEML. We have seen that change of management at the public sector company going from public to private. Eventually, just capture the kind of attention of investors, and you could see the stock rallying even further from these levels. On a more broader basis, because we are seeing an upcycle in CapEx, I think BEML should be pretty well placed and should be able to garner more orders. But as a PSU, it has been a bit of a disappointment.
Okay, all right. Well, before we move on, just pull up the intraday chart of AMI Organics. I pull up a month-to-day chart as well. AMI Organics has been moving very, very well. And today as well, the stock dipped a little bit, but it's moved to the high point of the day. Last 1 month or so, the stock is up close to around 15%. Some of these companies have not been able to scale up in terms of revenues. Let's see whether quarter four, the street is counting on quarter four being good and margin improvement as well. So let's see whether or not that does take place. For the time being, the stock is higher. But the one that's struggling today is Tata Chemicals. And we go across to Dipan to get his view on that. Kotak has written a note. They point out that the company has taken a 3 to 4% price cut in soda ash, both light and dense soda ash, effective yesterday. Now, the cut comes because prices have been, falling prices in China since mid-March. Not just that, there is additional capacity that could come on stream in Mongolia from May 2023. So ahead of that, they're seeing, the soda prices being corrected. Besides the prices, the problem is also in terms of demand. That needs to be monitored. To give you a number, soda ash as a percentage of the total consolidated EBITDA number is close to around 15 to around 20%, which will get impacted. Now, the price cuts, it could be partially, mitigated because coal prices are lower. So that's what they point out. And they're saying quarter four earnings, no worries. They have a problem with the second half of this calendar year that earnings would come under pressure because of this correction in prices and also highlighting demand out there. Dipan, what's your view? Tata Chemicals, yesterday in the final hour of trade, the stock took a sharp downtick. It was down close to around 2.5 to 3%. And today, it started off with a bit of a mild cut, but now the street is clearly cautious because as we speak, it's down a good 5%. Your view?
That's what happens, Nigel, with commodity stocks, that prices go up, prices go down, and that does impact the sentiment and the near-term performance. But Tata Chemicals is, I think, relatively attractively valued, point number one. And secondly, they are trying to move up the value chain and they're trying to capture all the chemical opportunities which are there on the EV space as well. In fact, Tata Chemicals is one of the key companies in the Tata Group when they try and build an entire electric vehicle ecosystem. in terms of chemicals and technologies which go into building a lithium battery or any other similar battery which will drive electric vehicles for Tata Motors. So I think that the medium to long-term outlook for Tata Chemicals is very good given the valuation which is trading at just now. Short-term, you may have to take a bit of a knock as far as quarterly numbers are concerned. But as I said, I think that going to move up the value chain, new capacities and specialty products are being ramped up. And you may have a soft quarter or two, but just based on that, I would sell off Tata Chemicals, given that a larger opportunity exists in some of the other products which are in kind of a scale-up mode.
Another big mover today is Just Dial. That's surging in trade, and the numbers look good. 5% quarter-on-quarter revenue growth, 40% on a year-on-year basis. Margins at a 2-year high, and the management has also guided that margin improvement will continue going ahead. And he also indicated that they're open to the idea of using the cash balance for inorganic moves. Listen in to what the management had to say, and then we'll get a sense of where the stock is headed from Dipan.
As we move forward into fiscal 24 and as our revenue converges with our collections for this year, this margin should sequentially keep on seeing an uptick, which is visible in last 2 to 3 quarters as well. So on a long-term basis, I think this business requires 6 to 7% of our top line to be spent on advertising. It could fluctuate a bit on a specific year basis. For coming year, I think anywhere around 35-40 crores definitely we would want to spend. And further increases could depend on how things are panning out.
Dipan, Just Dial has gone through a very rough, 2 to 3 years. COVID really impacted their SME clients, which in turn impacted the revenues of Just Dial, margins as well. But do you think the worst is behind now? And Just Dial is looking attractive. Ultimately, they do have Reliance as a promoter, and there would be long-term synergies with the two businesses together.
You're right, I think. And if you've seen the stock prices really started turning around and moving up since the change of ownership has taken place. And, with the Reliance management coming into place, you can expect more aggression, maybe newer products and service lines as well. But the biggest advantage of Just Dial is the kind of number of feet they have on the street and the kind of marketing network and team which they have, and again, they tend to build over there. Also, I think the overall trends in the advertising spend where MSME and SME advertising spends are going up will certainly benefit Just Dial, and another company that comes to mind is India Mart Intermesh. I think that also has been underperforming last several quarters. But both of these companies, I think, should start to do much better from this quarter onwards. The business is basically very high operating costs, so revenues when they start to grow, a lot of it finds its way into the bottom line. Valuations are reasonable for Just Dial considering the cash which they have on their books. The only real concern is that Just Dial was trying to get into the B2B space, which is dominated by India Mart. And I'm not sure they made adequate progress over there. At the same time, they were trying to get into e-commerce, actually getting into buying and selling of products, connecting the buyer and seller and routing it through their portals, but that also has not worked out. So end of the day, they still remain a kind of a B2C advertising, a yellow pages type of a business. And that at some point of time would have reached maturity. So it's a bit of a mix of positive and negative. But for the time being, I think looking at the numbers, you could see a further build-up and stock moving even higher from these levels.
Dipan, so just to add on the 2 points, one is their B2B business, which they call JD Mart, which compares with India Mart. We asked the management, how it's doing, and he's saying that it's actually been a big growth driver. Last year, it contributed 26% to their overall revenues, and B2B revenues is growing faster than B2C. On that second point that you said about e-commerce, they call it JD Shopping. And I think they're going slow on it because what the management told me is that they're still evaluating the unit economics of JD Shopping. So they're not yet pressing the pedal when it comes to JD Shopping, but their B2B business appears to be picking up, though it's still dwarfed by their B2C business. But do stay on, need to get into a break. On the other side, we also have our Alpha Manager of the Day, Aman Chauhan of Abacus Asset Management waiting by.
Welcome back. All about earnings. That's what this market is at the moment. And we are continuing with the analysis. Looking at Schaeffler, the stock is down actually about 2% The numbers looked okay. We have Sonia joining in with the fine print. Sonia, what's the key takeaway?
Actually, the numbers have slowed down quite a bit. If you look at it, both the revenue and the EBITDA growth has been in low single digits this time around. And it's lower than what some of the street was expecting. So if you look at it, the revenue growth was barely about 8% year on year. The EBITDA growth was just around 2% on a year on year basis. And the margins, in fact, have fallen 110 basis points on a year-on-year basis, coming in at 18.6%, barely a profit growth as well of around 6%. The management, in fact, speaks about how there are some external challenges that they are facing, and despite that, it has been a resilient performance from them. They say that the automotive technologies and the automotive aftermarket business has registered a strong year-on-year growth, but this is, because of their own operational efficiencies that has helped them mitigate the external headwinds, resulting in resilient margins. So there are external headwinds that they allude to. They also say that they have taken cognizance of the volatility and the challenges in the market environment, and despite all of that, they are committed to continue their growth performance. So the management commentary is a bit cautious. The numbers are, it's just barely about low single-digit growth that they're seeing and below street expectations. Hence, the stock is under a bit of pressure.
Okay, got that, Sonia. Thanks very much for the details over there. Deepan, hi, good afternoon. Wondering if you've seen Schaeffler of late. Sonia's pointing out to some concerns around growth slowing down. Thoughts on the stock?
No, I think Schaeffler has done really well over the past several quarters and has created a lot of value, post all the restructuring. And I think that this may be just a transient phase for them, because if the overall economy is picking up and their real customer base, the automobile industry, the engineering industry, and overall industrial activity picking up, that augurs very well for Schaeffler. At the same time, I think they're pretty well placed in terms of competition. Threat from Eastern European countries and China has diminished significantly. And also the cost of imports of steel being the biggest cost for them. Those prices also have flattened out and on a declining trend. So I think this is a bit of a transient phase, and we should see better numbers coming through. One should look at the base effect also, which is coming to play over here. Valuations are on the higher side, but given the kind of consolidation that has taken place and the move to quality within the industry, I think this company can certainly, be at least a market performer, if not an outperformer.
Okay, all right. Deepan, stay with us. But the sector of the day and of the past 1 month has been the pharma index. Brokerage firms like JP Morgan as well as Citi, they're getting incrementally positive on the pharma stocks. Ekta joins us to run us through their reasoning for suddenly turning a little bit positive. Ekta.
Thanks for that. Well, I'll start with JP Morgan, which is written on the pharmaceutical space. They pointed out that the Nifty Pharma Index is up around 6% in the last 1 month, outperforming the Nifty. Now, 5 reasons according to them, which will drive the sector performance through the year, include the fact that the India business is likely to see the highest price increase this year, aided by one of the highest NLEM, which is the National List of Essential Medicines, revisions. Secondly, for price erosion trends, according to them, they are moderating in the US generics versus the elevated levels that we've seen in the past 2 years. They also see opportunistic gains in US arising on account of increased drug shortages and supply disruption. They are also positive on the fact that there are easing input costs, freight cost normalization, which should aid margins. Sector valuations, according to them, are reasonable at this point in time. The top picks for JP Morgan are Sun Pharma, which has a solid domestic franchise, according to them, and their continued ramp up in specialty. Cipla, continued outperformance in the India business, is one of the reasons that they like that particular stock. Citi has also ridden on the pharmaceutical space, but they are striking a cautious note. According to them, the current optimism around the US generics pricing may in fact be short-lived. The biggest reason behind the continued pressure on generic pricing is factors such as aggressive scale-up by small and new entrants in the US generic space, which remains unabated. They maintain a cautious stance. They maintain that Sun and Torrent are their preferred picks in the Indian pharmaceutical space.
Ekta, thank you very much for that. Deepan, which one would be your top pick in the pharmaceutical space, including healthcare, diagnostic, across the board?
Well, I think Ekta has all smiles after a really long time, because pharmaceutical reporting disappointing numbers time and again for several quarters, and now finally there is some positive news on the horizon, so that's good. But I don't really like the space very much because it has got highly commoditized, at least the export business, be it in US, be it elsewhere in the globe as well. And really the actual value building is in the domestic pharma business, where brands actually still matter a lot. So keeping that in mind, we would like to remain underweight in most pharmaceutical companies. They're a very, very attractive valuation, no doubt, but that kind of a straight line secular growth is not visible anymore. But the favorite stock still remains Sun Pharma. Completely appreciate their strategy to move up the value chain by launching specialty products. I think they are again over here ahead of the curve, and we will see many other companies follow what strategy they are doing at present. But by then, I think Sun Pharma would be miles ahead. And if this strategy is genuinely successful and it becomes a major part of their revenues, then you could see a re-rating of the P multiple of Sun Pharma and a greater degree of stability and growth in earnings as well. So that's the only company that really we are tracking. And I heard about Divi's Lab earlier as well. I think we could see a turnaround over there because that's also another solid quality player. And eventually, I think the value proposition is very strong what Divi's offers. And it's just a matter of time before their custom synthesis business starts to pick up, and that's very high margin value add.
Okay, all right, got that. Dipan, always a pleasure speaking with you. Thank you very much for all the perspective on the stocks that we have discussed today. Have a good afternoon, and we'll catch up again soon. Well, with that, let's turn to our Alpha Manager for the day. Aman Chauhan of Abacus Asset Management is with us now. Aman, thank you for joining in. Good afternoon. And good to have you on the show. I'll cut to the chase straight away. I was combing through, the fact sheet that you sent us to see if you own any IT stocks, and I found one or two names here and there. I think there's HCL Tech on the large cap side, and there's also Emphasis. Are you concerned with what the two large industry titans have said and delivered, or do you think this is a one-quarter phenomena, and it doesn't really change your view on the companies you own and the sector overall?
Fine. For IT, I don't think it's just a one-quarter phenomenon. I think this could be 2-3 quarters. There's going to be slowdown in the discretionary spend, especially in the US and the European markets, which is the key target client for these companies. But having said that, these companies will continue to grow. The growth rates have slowed down, but it's still going to be a positive growth rate. And post this 1 or 2 quarters, I think the growth rate can pick up. And then this could be the good time to relook or maybe increase the weightages this sector. So I don't think one should write these companies off. Rather, it's just a 1 quarter thing. It's a 2-3 quarter phenomenon where maybe in the next 3 to 6 months, we'll find better opportunities to relook at this and invest more.
All right, Aman, and if you're looking at the IT names, we'll stick to the large cap.
We would prefer the mid caps because the large caps at the base at which they are currently at, the size at which they operate in, it's very difficult for them to grow at high double digits. So we would prefer mid caps where the growth rates can be at least mid-teens to high teens.
All right, Aman, before we started this conversation, we were talking about Dawa. I'm looking at your portfolio. You'll have Dawa and you have Daru also. Sun Pharma, you have Radico Khaitan as well out there. What's the view on both these two spaces? Because both of them are placed very, very interestingly. One has underperformed for many, many years, that's Pharma. And suddenly we're getting positive reports out there. And, the one that doesn't have any impact, whether there's a slowdown or not, Daru. How you're approaching both these two themes?
As far as the pharmaceutical sector is concerned, we feel the sector is close to bottoming out. For the March quarter, we're expecting earnings to be sequentially improving versus the December quarter. So YOY, some companies will still report negative growth. But since sequential growth is picking up, which means that the bottoming out process is on, and hence that makes a very interesting case to look at pharma names. Incrementally, over the last few months, we have increased our pharma exposure, and we have a pretty positive view on this sector. As far as the consumption of the discretionary consumption sector is concerned, we are neutral as we speak. Stocks have done well. Valuations are, I'll not say expensive, but they're cheap neither. So hence from here on, I feel there will be more of a market performer, a market return from these sectors rather than a big outperformance. So clearly, if you ask me between the two, I will prefer the Dawa.
Okay. Aman, don't see any big frontline auto names in your portfolios, at least in terms of top holdings, whether it's two-wheelers, four-wheelers. CVs are doing very well, but you don't have exposure. You've got an exposure to a company like Bosch. Can you tell us the reason why you've stayed away from a large exposure to autos, and what will make you change your view?
Yeah, you're right. We don't have direct auto exposure, very little of that. We are more towards auto angs and cap goods versus, say, auto companies. We feel it's the rally that we saw in the auto names in the past 6-9 months was more of tactical. They're underperformed for a very long time, and with metal prices cooling off, the street believed that the margins will come back to these companies, and hence auto was one of the best performing sectors in the last, say, 12 months. We felt it is more of a tactical trade. EV is writing on the wall. Most of the companies that are listed are not prepared for the EV. Whatever small exposure they have, say Tata Motors, which has an EV exposure, or Mahindra, which has EV exposure, but that EV is a very small component of the current total profit pool that they have. And hence, lack of a meaningful EV exposure for the companies, plus we felt it's more of a tactical trade. That's the reason we consciously stayed away from the sector.
Okay. Aman, also, I want to talk about financials a bit, because I think the markets, at least the view is very clear that this is one safe sector of the market. And if you're looking to move some money from, say, a sector like IT, a lot of it is finding its way into financials, right? You have ICICI Bank, that's pretty self-explanatory. But I want to understand how you're picking stocks in tier 2, tier 3, beyond banking as well. For instance, I think you have an IIFL in the portfolio, you have an Aditya Birla Capital. So what are the filters you're applying, and what are the trends you're looking out for in the non-bank universe?
So within the financials, except banking, focus is restricted to the larger NBFCs, where they have a decent liability franchise or will be able to garner funds. Over the coming, say, year or so, we feel only those institutions which are able to raise money would be able to fund their growth, right? So getting a good liability franchise is something which is very important, and hence we are restricting ourselves only to the top NBFC names. And beyond banking, there are some pockets where the growth rates are very high. Things are started to look up like microfinance. So we have increased our microfinance exposure. So we are looking at some small pockets here and there where a certain region or a certain segment can do well. So that's where our focus lies.
All right. What about metals, Aman? You all have got into a couple of these names quite early. The two stocks that come to my mind, top of mind, are Sarda Energy as well as JSL Stainless. Both of them have worked pretty well for you all. What are you all doing right now? Staying on the sidelines or looking to add some of these names?
Staying on the sidelines. We are not adding very aggressively on the metals name, but at the same time, pretty glued on as to what's going on. Some of the metal exposure that we have are also special situations, like the General Group is merging its two entities, and then it will be one of the largest stainless steel producers globally to the other company, which is also seeing some of its mines getting operational, which will add to the cost benefit. So it is just not pure play commodity plays for us. There's also some bottom-up positive triggers in these companies that we own. But overall, as far as commodity is concerned, right now it's pretty, can say, on the sidelines, at least for the next month or so.
So, Aman, right now, what is it that you are purchasing and you're comfortable buying? Because IT, you said you will look at buying perhaps 2 to 3 quarters down the line. You're staying on the sidelines when it comes to metals. Pharma is something that you've been adding on over the last few months. But what else? What makes it to your buy list today where you are comfortable?
So like pharma, industrial and cement specifically is looking good. Cement also is in the process of bottoming out. Sequentially, March quarter is going to be better than the December quarter. And from here on, we expect quarter on quarter things to improve for cement. Input prices are down, coal prices are down, freight prices are down, and growth is still holding on. So the demand for cement is still holding on. And that makes us pretty positive on this. Besides this, industrials is looking good. Manufacturing is picking up in India. Cap goods are looking good. We are just waiting for the better prices in the cap goods space. That space is looking very interesting. Hopefully, we have some results coming in where the growth rates for these few companies have not been that great. And if stocks correct because of that, it could give us good entry opportunity. So these are some of the sectors that we are currently focus on, besides obviously financials. So we are increasing our financial exposures also.
Okay, all right. Thanks a lot for stopping by, Aman, and discussing all those themes. We just refer to stocks, and then, in fact, we try to get your sense on themes. Good speaking to you as always. We look forward to having a chat with you in the near future. By the way, the mid-cap index continues to do well. That's holding at the high point of the day. And a couple of names that we highlighted at the start of the show. Ami Organics, which had a good listing, then it saw a sharp correction. Ami Organics has now moved to the high point of the day. The street is sensing that maybe things will come together in Q4. So that could be one of the reasons why the stock has moved now currently at the high point of the day. Well, we'll take a short break, and as always, we'll get you a check in terms of what's going on in dealing rooms. Nimesh is waiting for us on the other side on D-Street Chatter, and our technical experts as well will be back with us to give us some trading calls. Welcome back. Well, the mid-cap index continues to see traction out there, so it's a good time to get an insight into what's going on in dealing rooms. I know one better than Nimesh, who joins us to tell us what's going on in D-Street Chatter. Nimesh, what are you picking up today in terms of the flows? Yesterday, you told us that the FIs, they were not big buys. In fact, they could turn sellers, and that played out, though there was an element of a large trade in there. Today, what are you picking up?
Hi, Nigel. Today is a day of consolidation, barring that one intraday dip which we got on the back of reports of income tax overall. Actually, that dampened the sentiment to some extent, both in the broader market as well as in the large caps. But outside that, I guess another day of consolidation, largely on back of muted flows from the large institutions. Even today, the feedback is there is selling pressure, especially in large private banks, largely the HDFC twins, and select large cap IT names for the second day rank. So that's the feedback as far as flows are concerned. The sector of the day is clearly pharma. In fact, it's been the sector of the month, so to speak. The index is up 8%. Individual stocks are up 14-15%. Still, the sector is largely under-owned from the larger institutions' point of view, and hence you're seeing a bit of buying interest back in that particular sector. I guess earnings are going to dominate the theme, and we have some large earnings coming up this week, so that will set the tone. And on the upside, 17,850, 17,900 seems to be a resistance. But broadly, the selective selling by the larger FIs continues, and I guess earnings are going to be a big theme to watch out for this week.
What about stocks, Nimesh? What's on your radar?
Rima, as I said, there is selling pressure in select banks and IT names, but on the other side, there are some, random names which has been good buying in today's trade. So the two stocks that stands out purely on back of buying is Tata Motors and IndusInd Bank. No news, so to speak, but clearly, IndusInd Bank is buzzing largely on back of strong buy flows, and so is the case with Tata Motors as well. The delivery volumes are going to be quite high in both these stocks, so that's the first set. The second stock is Graphite India. That stock is buzzing in trade today on good volumes. A couple of reasons. One, the key reason is, I believe, a large selling pressure from a domestic mutual fund seems to be largely over, and hence you're seeing an up move in that stock. And the anticipation is maybe Q4 could see a bit of a reversal in terms of earnings as well. So that's something to track in Graphite India. The third stock is Zensar. Again, mid-cap IT name, under pressure on the back of selling across IT names. But again, this is one stock where some bit of HNI action is back, and there is good volume as well at HNI. So maybe some buying is back with some larger HNIs in Zensar Technologies. So that's the third one. And the last stock is Varun Beverages. Again, a large block, and after that, stock is down 2%. Looks like one of the long-only FI was a seller in today's block. So the disclosure could be important, but the stock is under pressure, largely on back of a large block in Varun Beverage.
Okay, got that. Thanks very much, Nimesh, for all the action from the street. As always, and the street is, still down. The Nifty, that is, at least, is still down about 42 points. Bank Nifty's got some green back on the screen. It's been a choppy day. Let's bring in Mitesh once again. Mitesh, so yeah, it's not been straight line on either side today. What's the advice for the final 20 minutes and some trades perhaps for tomorrow as well?
Yeah. Well, I think, as I said, the next few days could be spent consolidating. I think that process began yesterday with that gap down which was caused by infy numbers. And I think that still will hold for a couple of days more. So I think another 2, 3, 4 sessions could be spent sideways. Idea is to be, buy more on declines and closer to about 17,600, the better it is. And the stop loss should be below 17,550, maybe 10 points below that. So I think that's how we'll approach it. I have right now 2 names on the BTST list. Ipca Labs, again, a pharma stock, rebounded well from the lower levels today. That's BTST with a stop at about 824. Look for targets of around 840 here, and ICICI General Insurance Company, that's also on near to the day's high. That's broken out after about 3 weeks of consolidation. So keep a stop below 1120 and BTST for target around 1140, 45 can be looked at.
Big move in ICICI Lombard, Mitesh, as you were talking. The stock has surged close to about 2.25%. Thank you very much for that. Let's quickly run you through some of the big earnings for tomorrow. One of them is going to be Tata Communications, and the stock is down 2.5%. Now, broadly, the street is expecting a steady performance. Now, Tata Communications is an enterprise telecom player. It gets its revenues from voice and it gets its revenues from data. Now, data is 70% of their revenues, and that's what the street focuses on because that's the growth area, and it's expected to be steady. So a top line growth of about 11 to 12%, a little bit of a margin compression, and that's because the company has been adding to its headcount, which could hurt the data business margins. But I asked a few analysts, the factors, the enterprise cutting down in their tech spend, it hurt Infy and TCS. Will it hurt something like Tata Communications? And here's the answer that I got from analysts. They're saying it's unlikely to get reflected, at least in the current quarter, because the company is sitting on a very strong order book. In fact, the company has had a strong order pipeline for the last few quarters. They were unable to execute it due to the chip shortage. Now that the chip shortage is getting resolved on the sidelines, the company is able to execute on its order book. So this macro uncertainty in US and Europe is unlikely to hurt Tata Communications in the current quarter. But what the street will track very closely in the future is the order book or the order pipeline slowing down due to the macro uncertainty. And that's going to be a metric. But purely for Q4, it's expected to be a steady quarter. Expect the company to, meet its margin guidance of 23 to 25%. So that's on Tata Communication, numbers out tomorrow. Another one will be ICICI Lombard, which will be reporting numbers today. Surbhi is here with the key expectations. Surbhi.
Thanks for that. So ICICI Lombard is going to come up with its Q4 results post-market today, and it is expected to be a mixed bag. The GDPI, which is the gross direct premium income, is expected to be up by 11% on a year-on-year basis, but sequentially it's going to be lower due to the sell down in the motor third-party portfolio. Our poll suggests that net earned premium is going to be up 21% on a year-on-year basis at 377 crores. PAT is also expected to grow on similar growth rate of 21%. The combined ratio is expected to stay at elevated levels, which is in line with what the management has been guiding for the past few quarters. It is expected to be at 105% versus 103% same time last year. Other than that, the claim ratio is likely to see an improvement on a full year basis. We will also watch out for any commentary on pricing and the distributor payout front.
We'll keep an eye out on those numbers. Thanks a lot for that, Surbhi. Well, not too much action in terms of the markets as of now. The Nifty Bank, it's still more or less flattish, but mid-cap IT is actually making a comeback in style. Coforge is higher, Emphasis at the high point of the day. Even Birlasoft, that's half from the top. Well, that stock as well is bouncing back to good to see some pockets of the mid-cap index doing pretty well. But Jai Bala of cashthechaos.com joins us now. Hi, Jai. Good morning. Thanks so much. Good afternoon. Thanks so much for joining in. Jai, what about the index? You have been fairly negative on the index. Then we saw that counter trend bounce. Do you think that we're done with it and we'll resume the decline? We're in a phase of consolidation from the 17,650. Where are we headed?
Hi, Nigel. Thanks for having me on the show. The bounce from 16,828 that we saw, and the market touched somewhere close to 17,840. It looks like it is done, but we need confirmation from the market. If the market were to take out the low that registered on the day, that is yesterday, Monday, the market's reaction, the low registered after market's reaction to Infy's results, if that low gets taken out, it's highly probable that the markets have completed its counter trend move. 3-4 weeks back, when we had discussed about the gaps in the market and had projected the March gap to be touched, but the market exceeded that and completed the February gaps too. So we watch out for the break of Monday's low. Once that is done, the market will signal the counter trend rally is done.
What about banks, Jay? The Nifty Bank has been showing some relative strength. This month, while the Nifty is up 1.7%, the Nifty Banking Index is up 4%. What are you observing on the charts? Is the counter trend rally done there too?
The banks, have slightly exceeded the previous resistance that I had projected, and but the structural pattern hasn't changed. It might still, try to push closer towards 42,900. But if the banking index were to break 41,700, that will signal the counter trend bounce is also complete. The index is holding up well for now, but some of the key stocks, something like watch out for ICICI, Axis. These are the weaker pockets there. If ICICI were to break 864 and Axis were to break 860, that will put pressure on the market. And SBI comes to a resistance. It's not yet showing weakness, but if it were to break below support, that will also likely to contribute. So these are the three I'm keeping my eyes on for the markets to signal within the banking sector that it is also turning lower.
Okay, so Jay, I guess you're retaining your bearish view. You're saying this counter trend up move is coming to an end. Is this a call, just on what you're seeing in India? Or are you seeing some more evidence across international charts, whether you're talking about US bond yields, dollar, the US market itself? Any other trends that you're picking up right now?
There's a little bit of a point to be made on the Indian market itself. Then, before I get to the global picture, the Nifty IT, which is heavily weighted towards Infosys. I look back to 21 years of data going back to 2001, 2002. Whenever Infosys cracks in the first quarter of the calendar year, it tends to have a cascading effect on the Nifty. If say something from a 2 weeks to 12 weeks perspective. But the number of times it's had an effect from a 12-week perspective is far less, but often it has an effect from 4 to 8 weeks, and the decline for the Nifty has been somewhere between 3 to 8%. So this is just a visual analysis. I haven't documented as a statistical analysis. I had planned to do it, but I hadn't had the time to do it. So that's something you need to bear in mind. When it comes to the US futures, the NASDAQ is the one that's holding up. I've been repeating that for 2 weeks. So I'm waiting for the NASDAQ to signal that the counter trend bounce is complete. There's no doubt that it's a counter trend bounce for the NASDAQ. If the NASDAQ futures were to break below 12,634, it's a little bit of distance now. But if it does break, that will signal that the global markets are also turning lower. And the European markets have shown a considerable amount of strength. And if the Euro Stoxx 50 were to make fresh 52-week highs, from a contrarian perspective, it will be highly bearish because it will signal the completion of a move from the pandemic low. So watch out for these global factors. Again, the 10-year yields in the US, if it were to take out 3.611, that will also signal the resumption of the uptrend that started from the last year lows, somewhere about 0.8.
Jay, what's the NASDAQ futures level you mentioned, where a downtrend will be confirmed then that you're watching out for?
12,634, an intraday break would do. I don't need a close there. Just an intraday break below 12,634 on NASDAQ futures. That's the very important support I'm looking for. If the index were to make fresh, say 52-week highs, that won't change the picture because it's a confirmation that we already have a choppy overlapping move which signals this is only a counter trend bounce.
All right, Jay, you've given us fair amount of details on the equities and equity indices. And a couple of stocks as well we have mentioned. Let's turn our attention away to a couple of other asset classes. What about the Bitcoin? It had a total counter trend move. In fact, in 2023, that's the best performing asset class, I think so, from those bombed out levels. Where is that one headed? I mean, everyone's celebrating $30,000 odd. Where do you see this move? Point number one. That's the one that equity market watchers are maybe watching it or not. But the important one is going to be Brent crude. That as well has seen a bit of an up move, stabilizing around $85 per barrel. We're interested in that, from an equity market perspective. So your view on both these two assets.
Yeah, Bitcoin, as you rightly pointed out, it's acting from a very short-term perspective like a safe haven. And I know the recent turmoil has pushed the crypto to rally quite well. There are two possibilities here. One is a bullish possibility that the crypto Bitcoin has bottomed and is going up in a long-term uptrend. But my preferred choice is that the 31K that is put in just recently has probably part of a down move that is yet to complete. I would like to see the crypto go below the last year low, somewhere close to 14,500. Once that is done, it will be a long-term bottom for the cryptocurrency. But if the crypto were to hold about 24K, that's quite bullish. It would mean that it's already bottomed and it's going for a record high if it were to hold about 24K. Brent, as I've been pointing out, 87 to 91 is a very important range. It's highly probable that it's got little more upside to work with for the Brent variety, say somewhere close to 89, 90, and then from a 3+ months to 6 months perspective, I see Brent cracking below 65. So right now, from an extreme short-term perspective, I'm not sure if it's completed the move, owing to the cartel, OPEC cartel, trying to keep the prices up. But it could have a little bit upside left, but very bearish from a medium-term perspective.
Okay, stay on. Brent headed down, so bearish on Brent, bearish on equities as well. Do stay on, Jay. Need to slip into a break. We'll come back and we'll also get in the closing rates for today.
Welcome back. We just have a couple of minutes to go before the day closes out. Let's get you an exclusive story. Then India's full-service airline Jet Airways has completed 4 years of being grounded. The airline was admitted to NCLT for insolvency in June 2019, and there's still no clarity on when it will return to the skies in its new avatar. Sources are telling us that the Jalan Kalarok Consortium is yet to make payments to lenders, even as the deadline is just a few weeks away. We have Madiha joining in with the latest. Madiha, what are you picking up?
Well, 17th of April 2019 is when Jet Airways flew its last flight from Amritsar to Mumbai. And many have been hoping to see the airline back in air again. But the resolution plan has been quite a lengthy exercise, and the key issue largely remains the same. The Jalan Kalarok Consortium, who had won the bid to take over the airline, is yet to receive the airline's ownership. And the reason is pretty simple. The consortium hasn't made any payments to the creditors so far. Now, banking sources tell us that the airline's ownership will only be transferred after the consortium pays 270 crore rupees to lenders as the first tranche of payment. And not just that, JKC is also required to pay 225 crore rupees towards gratuity and PF as ordered by the Supreme Court. The consortium has been in talks with lenders ever since the NCLT had refused to stay NCLT's order that had directive for implementation of the resolution plan. Now, remember, the NCLT had set 16th of November as the effective date for the plan and had directed JKC to pay the creditors the first tranche within 180 days from then, which is the 13th of May. So that's one deadline that's fast approaching. Then there's another one that Jet is staring at, a very crucial license needed for an airline to fly, which is the Air Operator's Certificate, is expiring on the 19th of May. Renewing the AOC is not simple. It requires an airline to demonstrate its capability to run scheduled operations with the required fleet and staff that Jet Airways doesn't have currently. So will JKC be able to turn things around before these deadlines and get the airline back in the air? That's the key question right now, because time is clearly running out. We reached out to the Jalan Kalarok Consortium, but they're yet to respond to our query.
Okay, all right. Thanks a lot, Madhya, for joining in and giving us that quick update on Jet Airways. Well, we're almost done then with today's trading session. So let's start winding down the markets for you. Yes, we ended another session in the red, but there were plenty of winners in today's trading session. It seemed that some of those defensives, they came back, and they came back in style. The biggest gain on the Nifty was Divi's Laboratory. Post that export data, which looked quite smart, the stock has been moving from strength to strength. Today on the verge of moving to around 3,300 rupees. HCL Tech as well, valuation comfort out there. That stock was high with a gain of around 2.5%. Cipla as well did pretty well. And from the banking names, well, the Nifty Bank ended more or less flattish, but IndusInd Bank was up closer around 2%. Nestle was back over 20,000 rupees in today's trading session, and that one did pretty well. On the flip side, you had some of those domestic-facing themes actually that came in for selling. Power Grid, Ultratech Cement, Reliance Industries, the Adani Ports, all of them were under some pressure in trade today. But guys, the real focus today was on the broader market. So we go home with the cut of around 45 to 50 points. But boy, oh boy, big winners from the mid-cap and small-cap indices.
Absolutely. The mid-cap index up 0.7% and outperforming for the second consecutive day. Though the advanced decline ratio did narrow by the end of trade. Through the day, the advanced decline ratio was firmly in favor of the gaining side. We had about 3 stocks in the green for 2 in the red. But by the close of trade, it turned out to be an even keel. So to quickly run you through some of the big winners, and many of them were earnings reaction. So Just Dial was a strong mover today, ending up 2.5%. Angel One higher in trade. On the losing side, you had Tata Chemicals, where soda ash prices have been lowered by the company. This is what Kotak Institutional Equities tells us. The stock goes home with a cut of nearly 6%. Quickie lower 4.5% after revenues decline more than 50% on a year-on-year basis. And Network 18, TV18 end with a cut of 3.5% at the closing bell.
Oh yes, those are the result reactions. Beyond result as well, I mean, big movers. Look at a VIP Clothing 7% up, a Mirza International 17% up, Sobha 7.5%, Graphite India 7%. So it's very clear the actions just for the time being till the indices figure out what they want to do. I think the actions just shifted to individual stocks. It's a very flat close for the Nifty, but yesterday's low has been protected. So I think that's a takeaway that the bulls will probably like from today's action. And we have 2 days done in the week with the Nifty at the 17,660 level.
With that, we're going to wrap up on this show. Closing bell. Thank you very much for watching. Don't go anywhere.